So let's see what Robert Schiffman has to say. He's been in the hot seat. He's been following all of this. He's Bloomberg Intelligence Senior Technology Credit Analyst. He joins us here in the Bloomberg Business Week studio. The longer this goes on, do you get more nervous, or do you feel like, okay, this is all making sense, though, because we do see the demand. That's real.
Yeah, I don't get nervous. I'm pretty confident in my bullish views. I'd love to be the voice of reason, at least for 30 seconds.
Okay.
If you take a step back, so NVIDIA's in the news today, most read article, the sky is falling. But what has NVIDIA done over the last 5 years? Its stock, I'm a credit guy, its stock is up 1,000%. Its stock is still up 5% year to date. S&P's up 6-7%. Nasdaq's up 6 or 7%. We don't go up every single day in equity markets. We don't go tighter every single day in credit markets. So we're going to be a little bit bouncy. But that being said, what gives me my bullish viewpoint is, quite frankly, the fundamentals, the evidence that growth is here and it's only getting bigger and better and it's going to stay, hasn't gone away. And the evidence is it's only getting bigger and better. Now, from the credit markets, it scares people a little bit because you have to finance it. You got to put in the work, the time, the effort, and the money up front, and you don't see it for a few years.
Yeah, hello, Alphabet last week. Cash flow negative.
Yeah, I would argue, listen, I said this with you guys just 3 months ago when NVIDIA reported. I thought it was the best print potentially in the history of the stock market, and the stock was down. Alphabet's numbers were enormous, right? You've heard it. I've heard so many people say the story again today. Cloud AI growth was 82% in the quarter, but they boosted CapEx again by another 10 or 15 billion dollars.
Yeah.
So the world starts to freak out that they can't afford it, that there's not going to be enough money to lend to these guys. The cost of capital is getting way too high. And the sky is falling. And quite frankly, it just isn't.
But as some of these companies, we've always talked about their balance sheet and how much cash is on their balance sheet, and it feels like things are shifting. Is that a worrisome? Should we be concerned about that?
Well, we should be worried that...
It means less buybacks and things that investors have enjoyed, but I would push that aside.
The technicals in the market have clearly gotten weaker. So if we just also take a step back and think about how trading desks, corporate bond trading desks work today versus how they worked 5 or 7 years ago, is that desks used to take risk. So when you had sellers, you actually had the banks buying back their deals, sitting on maybe tens, hundreds of billions of dollars of bonds, and helping reduce volatility in spreads. Nowadays, no bank takes risk anymore. So when you have sellers come out, you see exaggerated spread movements. On top of that, when you see deal after deal after deal, and we've heard it, there's fatigue. When there's long-dated bond deal after long-dated bond deal, and we think that's going to happen again next year, just the cost of having to do business is going to go up. If you're selling something today and you're going to sell another 100 of those tomorrow, the cost is going to change. So the costs are going up. But if you think about cash, there's a lot of cash that's sitting around still. Look at Alphabet's balance sheet. They have $240 billion of cash on the books, and they still have another 30 or 40 odd of equity to issue that they haven't issued yet. So they have effectively pre-funded themselves, I think, for a couple of years. They're just taking advantage of there's still a bid for corporate bonds these days, albeit at a higher cost. And the other cash is just NVIDIA. Why is NVIDIA? They're the rich uncle that comes to the house and is doling out $20 and $100 bills. Is that necessarily a bad thing? Take a look at the FA screen on the terminal. The market believes NVIDIA is going to generate $200 billion of free cash next year.
Right.
So it's a little bit, I don't want to say Robin Hood, but it's the rich giving money to the wealthy right now. So it's just a sort of a temporary shift in assets.
I know we're talking credit here, but I want to broach something that we broached with Ed Ludlow a little earlier, and that's sort of like the end game here when it comes to these companies and this world that they're trying to create. From where you're sitting on the credit side, just what does the world look like if these investments work out? Like, what are we doing differently? How are we getting to work differently? Are we working 4 days a week because we're so productive? Like, what are the promises that have to play out in order for these investments to be successful?
Well, BI Credit works 7 days a week. I don't see that changing. So
just wait until we have 24/7 trading.
Financially, what does it look like? I think it looks like where we were 3 years ago, when the hyperscalers, which were previously, Mag 7, had a lot of other different names, were just generating so much cash, they just were buying back tons and tons of stock. I actually think we're going to get to that point again where they're going to be NVIDIA-like, where there's going to be so much excess cash flow, they're going to have nothing to do with it but buy back stock. Now, I don't think that inflection point starts probably until late 2028 or 2029. When you think about the world that we live in, clearly, listen, that's going to change. All of our jobs are going to change, and some for the better, some for the worse. Like everything that we do at Bloomberg is changing now. We're utilizing Ask B, we're utilizing automated research, and it's not to replace analysts, it's to make us better and more efficient. And I think that's what's going to happen with the rest of the world is everyone's going to get better and more efficient. But some of the moves we're seeing today are exaggerated. There's other names like IBM, for instance.
Yeah.
They fell 25% after earnings. And when they actually guided preliminarily, we didn't know what they were going to come out with full guidance. The guidance prior was revenue growth of over 5%. Then they guided to 4 to 5% revenue growth without a change in free cash flow. Is that company worth 25% less? I'm not an equity analyst. I'll tell you from the credit standpoint, spreads shouldn't be very much wider, and they're not.
It's interesting, kind of related, I guess, if you will, but there's a story on the Bloomberg today about Morgan Stanley saying AI adopters set for solid profit margins. So they say U.S. companies that are integrating AI capabilities are poised for stronger profit margins.
Because we're becoming more productive or because they're replacing people? That's the question.
Mike Wilson and his team said margin expectations are improving most clearly for companies where AI is central to their investment thesis and pricing power is neutral to strong, I guess this is where when we go through the earnings season to find out exactly what folks are doing, think about everybody we bring on and we ask them, like CEOs or even like investment folks, like, are you using it? Everybody seems to be using it. There is a point, though, where people are starting to say, do we need all the models? Do we need all the expensive models? Does everybody need access?
Are we using it too much for the right reasons? Like, are we spending too much in tokens?
Yeah.
I don't think we are. I think the real question is, are we spending too much money on something today that we can spend half as much on tomorrow? That's the real fear, is that China comes in and just creates a better, cheaper mousetrap, and everyone's sitting now on trillions of dollars of spending. And if they just would have waited a couple of years, they could have spent half the amount.
We've already talked about this. Is it the Chinese model where some companies are playing around with it?
Yeah, I mean, this is the DeepSeek scare from last year that we spoke about.
Yeah, and I think the answer is no. If we look back at what happened with DeepSeek, right? It was this sort of moment where everyone was panicky, and then what happened? We hit all-time highs again. So I think that's eventually going to end up happening. I do think the credit markets are deep enough to finance all this. There's a variety of different things that are happening. There's a host of SPVs that are being priced. Now they're off balance sheet, and that's an interesting sort of trade, but there's tens of billions of dollars of private capital that's around. There's tremendous amounts of non-US dollar currency that's still likely to be raised. That helps with technicals. And then I think the other step, and this is bad for the equity markets, I guess, is that I think you're going to see more equity issuance. We saw massive issuance out of Alphabet. We've actually seen that out of Oracle. Obviously, SpaceX did a big deal. And I think others are going to follow. And by the way, with things like SpaceX, which are wider, nothing's changed. Zero reporting. They're 100 basis points wider.
Robert Schiffman, this is Bloomberg.